Hi, everyone, and thanks for joining us. Anthony Scilipoti here, President and CEO of Veritas, and I'm joined today by Darryl McCoubrey, our head of research. Darryl, how you doing?
Not too bad.
What a time indeed, and may you live in interesting times, as they say. So we're back again, and we're going to look and reflect on our V-List performance through the end of February. And the V-List is something that we started back in 2004. And it was launched to be our best ideas. And it's a bottom-up, fundamental-based construction. We look at the accounting, at the disclosure. It's concentrated, 12 to 25 names. And we do things on an equally weighted basis, low turnover, completely sector agnostic, and we focus on larger cap Canadian companies. I'm proud to say that our performance has been quite good. Last year, ahead of the index on the year to date, if we look through the end of February, by almost 11 and a half or so percentage points, and year to date doing really well. And since inception, ahead of the index by over 300 basis points. Now, the key to this outperformance, and this is where I'm going to turn it over shortly here to Darryl to get through so a little bit of the particulars, has been our interest and allocation to energy. And as this chart shows, since the inception of the V-List, and this is just going back here to 2013, you can see by the various colors, and it's really to emphasize the sector agnostic bottom-up perspective. We're looking for companies that generate returns. And as a result, it doesn't matter if it's a bank or an oil company or a consumer discretionary. If we see that that's got the best upside, that's going to be the company that we're going to add to our list. And the key emphasis is downside protection. So we're favoring stocks with downside protection with catalyst to the upside. And Darryl, maybe you could talk to some of the changes we've made in the recent quarters.
Well, yeah, I mean, Anthony, we've reduced our exposure to REITs. We've also swapped up some of our exposure within the financials. But you'd referenced earlier that we've gone, a little bit overweight with regard to energy. I say only a little bit because we're an equal weighted 25 stock maximum little portfolio that we run here hypothetically. And so if we were to go complete just balance with our index, the composite, we'd have 4 names, but instead we have 5 names. And the 5th name is Enbridge. So I'm not sure you'd consider that to be, the same exact risk profile as what typically would constitute an E&P play. And so if you want to go to the next slide, we can discuss the process around why we're overweight in that sector, which has been driving our positive growth. Unless, of course, you want to discuss further some of the changes that were made to the V-List.
No, I think we should really dig into the energy space, because that's where we've added to over the last 6 months, really, to create that extra couple names that have brought us overweight.
Yeah, happy to. And I mean, this is where I think transparency is key. We follow this process pretty much every time that we get ideas for either additions or subtractions to the list. We're an independent research shop, so we truly do empower our analysts. When they come to us with suggestions, we take them very seriously. And so relying on that, I think, gives us a bit of an advantage. And we specify here that we analyze assets and accounting, and the accounting can be very important for certain stories. I don't think the risk is as high inherently within the oil and gas space, but certainly, I know within utilities, you can have significant differences in accounting and policy choices and non-GAAP selection that can, throw aside comparative analysis, which is the next step, right? It's once we get to a good number, we want to see whether or not that return is appealing compared to other investments we could take that have similar risk. And then ultimately, when we make our action movements to remove or to add a stock, this is where the job gets really, really hard. This is where it comes down to qualitative assessment. For oil and gas, it's a qualitative assessment of where we think demand's going to go versus expectations from the market. For oil and gas, it's also an outlook on inflation and how if we don't drill more, we're likely to have much more inflation than we need to. And that's clearly going to be a big issue, I think, moving forward, given affordability constraints with prices where they are today. And so, yeah, we can go into, I think the next slide kind of highlights exactly how the oil and gas sector would fit within our template. I don't know if you want to take over here, Anthony. I think you're pretty much aware of this as well.
No, but I think, here it is, we're relying on this independent analysis of the assets and the accounting. And the accounting, in the oil and gas space is not clear cut. What do we do with interest costs? What costs get allocated to which properties over what time period? What are the reserve estimates, et cetera? There's a lot of particulars that you need to dig through. It's not just looking at the earnings, and especially important in the energy space is cash flow. So when we look at it, we saw that the space generates about 15% plus returns on a pre-tax basis, returns on invested capital. And that, as we saw that really expand through the 2021, as the names were very depressed relative to what we saw as the expectations for the underlying commodity, we saw that this was an asymmetric situation for us to make these type of investments. And I like, maybe you take over the next part and you compare the core returns.
Well, also, just before you move on that 15% pre-tax ROIC, let's not forget the backdrop. As we were making some of these additions, we had EV/EBITDA multiples across Canada in excess of 20 times.
Yes.
So that 15% plus pre-tax ROIC, which is taking CapEx into account, compared to EV/EBITDA multiples of other assets out there in the market, trading on average at 20 times EBITDA for a while. And I know that's pushed by a certain small segment of the index.
Called technology,
kind of speaks to the appeal of when you can get this kind of premium.
Yeah, we hardly had any. I think we had virtually no technology coming through 2021.
So this is why we were willing to go a little bit above balance on the energy exposure, I think. And ultimately, what names we selected within the energy space, it came down to a lot of factors, right? Like immediately we wanted liquidity, we wanted larger names. We try to make this, it can't ever be perfectly realistic, but we do want to be cognizant of, limitations in the real world of running a portfolio. Diversification, we didn't just want oil, we wanted some gas too. And then obviously returns, we were willing to take a little more commodity risk so long as we were comfortable around the balance sheet mostly.
And I think, now as we've seen this big spike, that's been driven obviously by the horrendous acts that are taking place in Ukraine, and we're seeing the huge spike. That's obviously not something that we factored into our model, but we're watching carefully here. We were talking about it yesterday, actually, digging through where is it going to be from here, and which price is sustainable. And for now, we're holding on, and we're watching carefully the specifics that take place in the war, because that's obviously going to have an impact. But longer term, I think you'll agree, Darryl, I think we're here for higher energy prices, and I think that's going to bode well for our holdings.
Yeah, I mean, I don't know if the spike in energy prices we've seen around the conflict would be sustained if we all got great news that the conflict ended. But that's not necessarily going to impact our view on value in the sector. I think we've identified structural issues around, our world's demand for energy and the choices of supply that we have. And so when you look into those questions into a little bit of depth, it starts to become clear that oil and gas are going to be big parts of the transition.
All right. Thanks very much, Darryl, and thank you all for your support.